What's up guys, Humphrey here. So ETFs are really good for the investor that wants to buy and hold, grow their money passively, and not pay a ton in fees. Growth ETFs are a category of ETFs that are designed to outperform the market so that you can go to the moon in the safest way possible, of course. Now personally, when I was a kid, I wanted to be an astronaut and actually go to the moon or outer space, but in the investing world, going to the moon means something different. According to UrbanDictionary.com, going to the moon means that your asset price is going through the roof. There are many ways to get to the moon. Investing in Dogecoin would be like buying a ticket on an untested rocket. Versus growth ETFs are like having an Apollo mission with a team of NASA scientists ensuring its safety. I don't know about you, but I personally would want to be on a rocket ship that has a much higher chance of succeeding than, let's say, an untested rocket. Growth ETFs, by definition, according to Investopedia.com, are designed to invest in a basket of stocks whose underlying companies have the potential for rapid growth, as opposed to stocks whose prices are relatively undervalued. So in this video, I'm going to give you a brief overview of growth ETFs, and then we're going to get straight into the 5 funds that you can add to your existing portfolio for more appreciation and upside. I think if you're new to investing or just trying to build your first portfolio, having one of these funds to complement your core holdings could be a pretty good option. Now, as always, I'm going to leave timestamps in the description below for you guys so that if you want to just skip around, you can do that. And many of you guys that are watching me are actually not subscribed. So if you do end up enjoying this content, please remember to subscribe. It's free and you can always change your mind. So let's go over growth ETFs right now and the pros and cons of growth ETFs that I think are worth mentioning. The pros include having an investment that actually outperforms the market with higher upside potential. And also it's better for younger investors because you're so far away from retirement age, you're not really seeking income or dividends quite yet. The cons of a growth ETF include being more volatile, so they're taking on more risk to get those potential upsides. So there is a higher chance that you actually might lose some of your investment with a growth ETF, especially on a bad year. The other con is that growth stocks generally reinvest all their profits into the company themselves so that they can grow even further. So they're not really paying you dividends or income, so it's not really good for somebody who's nearing their retirement age. If you are buying growth stocks, it's important to combine them with value ETFs so that way you're creating an appealing risk to return profile. There is also an advantage that ETFs have over index funds or mutual funds that isn't really talked about here on YouTube, but what I've noticed is that ETFs are a little bit more tax efficient than index funds or mutual funds. That's because in those funds, the mutual fund manager typically has to rebalance those index funds themselves, and when they do so, they incur capital gains and they have to pass those capital gains on to their shareholders. Now, in an ETF, that doesn't really happen, so that's not a consideration you even have to make, and for that reason, an ETF is slightly more tax advantaged than an index fund can be. If you do want to know more about the differences between index funds, mutual funds, and ETFs, I do have a video on that that'll link in the description below for you guys. All right, so let's get on with the list. Number 5 in my list is ticker symbol VBK, and it's known as the Vanguard Small Cap Growth ETF. This is a fund that tracks over 639 different small cap stocks. Now, a small cap company, by definition, is known as a company that has between a market cap of $300 million and $2 billion. So they're smaller companies with bigger potentials of upside. This particular fund's breakdown is 24.4% of their holdings are actually in healthcare, followed by industrials, technology, and then consumer discretionary companies. What I do like about this fund is that not any one of the holdings represents more than 0.67% of the fund's total assets. That means in the event that one of the companies in the fund actually goes bankrupt, it doesn't really threaten the rest of your entire investment because you still have 638 different stocks to kind of hold that ETF up. The return since this fund was created in 2004 has been roughly 11% annualized, and in the last 3 years has returned about 19%. Vanguard ETFs are some of the cheapest on the market, so this one has an expense ratio of 0.07%, so that means it's about $7 in fees for every $10,000 you have invested per year. The downside of this fund is that it's definitely more volatile than some of the other funds on today's list. It has a lot of small companies with a lot of boom or bust potential. It's also important to note that some of the companies that are in this current fund are actually mid to large cap companies because initially when they were introduced in the fund, they were small cap companies, but they have since grown. And so in the future, they actually might get excluded from the fund moving forward. Now I did this next part just for fun, but let's pretend you had 10K to invest and you put it all into VBK and every single year you added $5,000 a year to it. Well, you become a millionaire in about 28 years from now because the annualized return is about 11%, so that's pretty interesting to note. Number 4 on my list is ticker symbol IWP, which is the iShares Russell Mid-Cap Growth ETF. Okay, so this fund, ticker symbol IWP, is like the big brother to VBK, which is the fund that I just talked about, but it essentially follows the same investing approach just for mid-sized companies instead. So a mid-cap company, by definition, is one that's between $2 and $10 billion in market capitalization, and this fund in particular encompasses over 356 different stocks. Its largest sectors are IT, healthcare, and industrials, and not a single holding represents more than 1.43% of the entire fund. In terms of its top 10 holdings, we're starting to see some more familiar names. For example, it owns great companies like Chipotle, DocuSign, and even Spotify. For its performance since it was created, it's been returning about 9.9% annualized, but in the last 3 years, it's been returning about 19%. Expense ratio wise, it's about 0.24%, so it's a little bit higher than a Vanguard fund would be, but again, nothing too crazy. So if you did have $10,000 invested, it would be about $24 per year in fees that you would be paying for owning this ETF. The fee typically comes straight out of the return when it comes to an ETF, so you'll likely not even notice that you're paying fees. It'll just be reflected in the asset's price. When I was doing my research for this video, I actually noticed that this would be a really good complement to the popular Vanguard S&P 500 ETFs that are out there. I really like the diversified exposure and the additional upside that it actually brings. The other thing I really liked about it is that you're investing in mid-cap companies, so it's not like you're taking on crazy amounts of risk to invest in this ETF, but you are still seeing some potential for upside, which is something I really liked. Now, personally, I added this ticker symbol to my own portfolio on Monday, so I usually do my long-term investing in Fidelity and Robinhood, and if you'd like a free stock from Robinhood, you can use the link in my description below for that. Just whenever you deposit $1, you get a stock valued up to $200, which is pretty cool. All right, the next ETF on our list is ticker symbol iBuy, or the Amplify Online Retail ETF. This is a growth ETF that doesn't really focus on a specific market cap size, but it actually focuses on companies that generate their primary income through online sales. So according to their website, in fact, it's a basket of publicly traded companies that obtain 70% or more of their revenue from online or virtual sales. This fund only has 58 holdings, so it's not as diversified as some of the other ETFs on our list, but the top holdings include really big names such as Etsy, Lyft, TripAdvisor, and Groupon. This fund is also way more expensive than any of the other ETFs on this list, with an expense ratio of 0.65%, which is almost 9 times the Vanguard average, which is pretty pricey. So for that amount that we're paying in fees, we better be seeing a good return. And luckily that is the case, because since the inception of this fund, the return of this fund is crazy. It's astronomical. It's almost to the moon already, but it's 38%. The 3-year return is even more impressive at 40.57%. So the returns are there, but again, this also has potential for volatility because it's really dependent on how the economy is doing. The economy is doing really great right now, so a lot of people are spending their money online and also in retail stores. But if the economy ever has a pullback or a recession, we actually might see this fund perform poorly. Personally, I only see online sales growing year over year, especially in the long term. Now, when it comes to this ETF in particular, I would really want to make sure that I'm balancing this ETF with some safer core holdings in my portfolio. Now, just for fun, if you remember my earlier example, if you put 10K invested into this fund and added 5K a year to it every single year, and you got the same average returns that it was returning, well, according to the compound interest calculator, you would be well over $1 million within 12 years at over $1.325 million. Now, again, guys, that was just for fun, but it was really to show you and illustrate that compound interest has a really big effect on how you can grow your money. Real quick, just to temper your expectations really quickly, the average return of the S&P 500 since it was created is about 8%. So if you are generating a little bit higher than 8%, that's already considered really good. All right, the second ETF on my list is the popular QQQ. And if you don't know what QQQ is, then I'm about to tell you. It's one of the most reputable and solid ETFs out there, and they're actually proud to be the official ETF of the NCAA, which doesn't really make any sense to me, since when do ETFs sponsor March Madness games? I don't really get it, but I digress. It's the #1 highest rated ETF according to Lipper in the past 10 years. It's the second most traded ETF in the US based on average daily volume, and it also lets you access NASDAQ's 100 largest non-financial companies in a single investment. The return of this fund since it was created is about 9.38%, and for the past 3 years, it's 27.34%, and its expense ratio is 0.2%, which is pretty reasonable. The top holdings include Apple, Microsoft, and Amazon, and of those 3 holdings, they actually represent 30% of the fund's total assets. Now, if you want to see the full list of what QQQ invests in, I'll make sure to link that in the description below for you as well. Now, one of the things people are going to say is that QQQ has a lot of overlapping holdings with the S&P 500 ETF, and while that is true, QQQ in the past year has has actually returned over 48% in the last year versus the S&P 500 ETF has returned about 19%. So even though it does have some overlapping holdings, we actually do see that the return has been pretty favorable for QQQ in the past year. And my number one pick for the growth ETFs today is actually ticker symbol VUG, which is actually the Vanguard Growth ETF. This is a fund that's comprised of 260 different stocks out there. Most notably, they're targeting growth and mostly large cap stocks. The weightings are done by the size of companies, so the top 10 holdings actually account for 45% of the total assets of this fund, and the top 3 holdings are also Apple, Amazon, and Microsoft. The expense ratio is a mere 0.04%, so again, that's only $4 of fees for every $10,000 you have invested, and it's actually the cheapest ETF on today's list. Now, in terms of its return, it's actually performed pretty well since it was created, around 11% average annualized returns, and in the past 3 years, it's over 23%. I like this fund in particular because it has a lot of upside, but it still has a lot of diversification and safety because it's mostly investing in large cap growth companies. It's not the riskiest pick in today's list. That award definitely goes to ticker symbol, can you guess? Well, it's ticker symbol iBuy. Now, if you're able to get that return with iBuy, then great, but if you're looking for a solid, more stable pick, then VUG is your best bet. If you want to see my entire portfolio and also get alerts on whenever I buy and sell a stock, you can do that in my Patreon. So thank you to everyone that's already supporting me there already. If you enjoyed the video, make sure to like and subscribe and also get your free stocks down below in the description. And I will see you guys in the next one. All right, peace.